For weeks, every headline has been about military tension in the Middle East, with everyone watching for the next shot to be fired. But what if the real battle has already started and it's not being fought with warships and drones? What if it's a silent war, waged in the very heart of the world's financial system? This isn't a what-if scenario. There's a market that keeps the US government running, and if that market breaks, everything else follows. One long disruption in the global oil supply could have deeply negative effects on financial markets. It could cause oil prices to spike and create instability in the global economy. That instability might then spread into other markets. Even the US Treasury market, which is usually seen as very safe and stable, could be affected. This is the same market that has to support a US national debt that is now blown past $39 trillion. The real story isn't just about a conflict in a narrow strait of water. It's about how that conflict could unleash a financial crisis in the one asset that's supposed to be the bedrock of the world. Section 1. The unseen battlefield, a $30 trillion powder keg. So, to really get what's at stake, you have to understand what the US Treasury market actually is. Think of it as more than just the place the US government goes to borrow money. It's the financial foundation for the entire world. With over $30 trillion in securities outstanding, it is the biggest and most important market on the planet. Its bonds are seen as the ultimate safe asset, the yardstick every other investment is measured against. Central banks all over the world, from Japan to the UK, hold these bonds as their safest assets. This market funds the US government, lets the Federal Reserve steer the economy, and serves as the essential plumbing for global finance, with nearly $1 trillion in trades happening every single day. But this foundation of the financial world is starting to show serious cracks. For years, analysts like Luke Gromen have been warning that a global debt bubble has been inflating, and we're now seeing the first signs of it bursting. The problem is simple math. The US national debt is exploding, recently blasting past 38 and now even $39 trillion. That's a jump of over $2.6 trillion in just the last year, which averages out to more than $7 billion a day. This isn't a problem for our grandkids. It's happening right now. At the exact same time this mountain of debt is growing, the market's ability to actually buy it all is shrinking. This is the critical weakness. After the 2008 financial crisis, new regulations were created to make banking safer. But these well-intentioned rules have accidentally created a new, dangerous problem. Rules like the Supplementary Leverage Ratio, or SLR, and the new Basel III Endgame framework have tied the hands of the big banks, the very dealers who are supposed to make the market for treasuries work. One rule, the SLR, affects how banks hold these bonds. In simple terms, it forces banks to treat a super safe US Treasury bond the same way they treat a much riskier loan. This gives banks zero incentive to hold huge amounts of low-risk, low-return treasuries, precisely when the government is selling them at a record pace. We don't have to guess what happens when this fragile system gets hit. We've had two very recent and very scary dress rehearsals. First was the dash for cash in March 2020. When the pandemic hit, investors everywhere panicked and tried to sell everything, including treasuries, to get their hands on US dollars. But the dealers, held back by rules like the SLR, couldn't handle the selling pressure. The market for the world's safest assets simply broke. For a terrifying moment, it was almost impossible to sell a US government bond. The Fed had to jump in on a historic scale, promising to buy over $1 trillion in treasuries just to get the market working again. It was a bailout of the system itself. Then it happened again. In March 2023, during the regional banking crisis, volatility in the Treasury market spiked to levels we hadn't seen since the 2008 crash. Once again, the system showed just how brittle it was. These weren't flukes. They were warnings. They proved that the Treasury market, the foundation of global finance, can't handle a real shock. The plumbing is clogged, just as the floodwaters of debt are rising. And now a geopolitical storm is gathering that could deliver that exact shock. Section 2. The trigger, how a strait can break a market. The event that could trigger this financial meltdown doesn't need to be a direct attack on America. It could be something far more subtle and in many ways much more effective. The key is the Strait of Hormuz, that narrow waterway between Iran and Oman. Before the recent tensions, this one choke point saw about 20% of the world's daily oil and about a fifth of its liquefied natural gas pass through. For countries like Japan and South Korea, that flow is essential. Analysts have long said that Iran's real weapon isn't its missiles, but its power to simply turn off the world's energy tap. If the Strait of Hormuz were closed off for a long time, it could create a nasty chain reaction that hits the already fragile treasury market. First, an oil shock would make energy prices shoot up around the world. We've seen this movie before. Conflict erupts, oil prices surge, and inflation fears kick in. When inflation gets hot, the Federal Reserve usually raises interest rates to cool it down. But in today's fragile environment, that's like pouring gasoline on a fire. Higher interest rates make U.S. debt more expensive and crush the price of existing treasury bonds. This is where all those vulnerabilities turn into a full-blown crisis. As bond prices fall, major foreign holders of U.S. debt, like China and Japan, face a tough choice. These countries are also massive energy importers. As analyst Luke Groman has pointed out, when oil prices spike, these countries suddenly have to pay way more for energy. To get the U.S. dollars needed to buy that expensive oil, they are forced to sell the U.S. Treasury bonds they own. Think about it from their perspective. Do you hold on to a U.S. bond that's losing value? Or do you sell it to buy the oil you need to keep the lights on and your economy from shutting down? It's not really a choice. This forced selling would dump even more treasury bonds onto a market that already can't handle the supply. The dealers, with their hands tied, would be completely overwhelmed. We'd see a repeat of March 2020's dash for cash, but this time it could be much, much bigger. The classic flight to safety, where investors buy treasuries in a crisis, could flip into a flight from treasuries, as everyone fears the market itself is breaking. This is how you get what some analysts call a doom loop. An oil shock creates inflation. The Fed's response scares the bond market. Major countries have to sell their bonds to buy oil, which pushes interest rates even higher. Higher rates mean the U.S. government has to pay more interest on its massive debt, forcing it to borrow even more money. It's a downward spiral that could end in a catastrophic loss of confidence. And if the world's risk-free asset is no longer risk-free, the entire global financial system, which is built on top of it, starts to crumble. This isn't a war fought with tanks. It's a war fought with interest rates and barrels of oil, and it's one the U.S. is structurally set up to lose. If you're getting value from this breakdown and you want to understand the hidden lines connecting geopolitics and your money, take a second to subscribe. We focus on digging into the stories the mainstream tends to gloss over. Hitting that subscribe button really helps us keep bringing you this kind of research. Section 3, the Endgame, money printing and the search for an exit. So what happens if the U.S. Treasury market actually freezes? What if the U.S. government needs to sell trillions in bonds to pay its bills, but there's nobody left to buy them? There's only one buyer of last resort, the Federal Reserve itself. In this scenario, the Fed would be forced to unleash another, even bigger round of quantitative easing, or QE. It would have to print money on a scale we've never seen before to buy up all the treasury bonds that nobody else wants. This isn't a guess, it's the only tool they have left. We saw them do it in 2008 and again in 2020. When the private market breaks, the central bank becomes the market. This would be a clear signal to the world. It would show that the U.S. can't pay its bills by borrowing normally anymore. Instead, it has to create money from thin air just to stay afloat. A move like that would shatter the U.S. dollar's credibility and almost certainly kick off a massive inflationary cycle. As analyst Lynn Alden has argued for years, we are in a long-term debt cycle where outcomes like this become almost inevitable. Facing this, regulators are scrambling to find a fix. There are talks about permanently exempting treasuries from that SLR rule. The idea is that if those bonds don't weigh down bank balance sheets, the banks will be more willing to step in during a crisis. Other ideas include a central clearinghouse for treasury trades to make the system more efficient. But these solutions are like putting a Band-Aid on a deep wound. They don't fix the main issue. The United States is trying to sell far more debt than the market is willing or able to buy. This leads to the ultimate question. What happens to the world order when the world's reserve asset is no longer trusted? For decades, everything has run on the US Treasury standard. If that standard breaks, all that capital will have to find a new home. This is where assets outside the system, like gold and even Bitcoin, come into the picture. If government bonds are losing their value because of all this money printing, investors will start looking for other places to store their wealth. They'll look for assets that are rare and can't be created out of thin air by a government. We always see a flight to these hard assets during times of stress and inflation. While it's still volatile, Bitcoin's role as a potential hedge is being talked about more and more. Some analysts point to its use by sanctioned countries as proof that it works as a financial system outside of US control. Bitcoin is decentralized, meaning no single entity controls it. That same quality could make it a potential disaster hedge for people and even nations who are afraid of their currencies being debased. This isn't to say Bitcoin is going to replace the dollar. It's about understanding that when confidence breaks, capital flows to where it's treated best, and a tidal wave of newly printed money is never a good host. The headlines are all focused on the visible threats of a war in the Middle East. They show us ships and missiles and fuel our fears of a conventional conflict. But the much bigger danger, the real war, is being fought silently on the trading desks that run our financial world. The United States built its global power on the dollar and the idea that its government debt was the safest thing you could own. But that foundation is now weaker than it's ever been. The system is struggling under a mountain of debt. It's trapped by its own regulations. And it's extremely vulnerable to one specific shock: a disruption in the world's oil supply. The potential chain of events is simple and scary. An oil price spike causes inflation. The Federal Reserve has to react, which could break the Treasury market. A broken market would force massive money printing, which then weakens the dollar. Every single step in this chain is a known weakness that has been tested before. The next time, it might not be a test. So as you watch the news, just remember that the most important battles are often the ones you can't see. The real war is a battle for confidence, and it's being fought in the heart of the US Treasury market. What do you think happens next? Let us know in the comments.